On a symbolic day soaked in patriotism and political theater, July 4, 2025, former President Donald signed into law what could become one of the most consequential tax reforms for American workers in recent memory, a sweeping legislative package that eliminates federal income taxes on tips and overtime pay for the tax years 2025 through 2028. While the fireworks lit up the night sky, the implications of this decision ignited debates across newsrooms, union halls, kitchen tables, and economic think tanks nationwide. Touted as a direct fulfillment of a campaign promise made during a fiery rally in Las Vegas back in 2024, this bill aims to appeal to the heart of the American working class: bartenders, hotel staff, gig economy laborers, retail clerks, and countless others who live shift to shift their livelihoods, often dependent on tips or extended work hours. Under the new law, any individual earning tip income can deduct up to $25,000 annually from their federal taxable income, while workers receiving overtime wages are entitled to reclaim federal income tax on those extra earnings when filing their tax return, regardless of whether they itemize deductions. Donald and his allies in Congress framed this legislation as a long overdue correction to a system they claim unfairly the backbone of the service economy. Those who often earn the least yet pay a proportionally high share of their income in taxes. In front of a crowd of flag-waving supporters, Donald declared, "America's workers are no longer going to be punished for working harder and serving others. If you work overtime or earn your income through tips, you keep more of what's yours, period." The White House estimated that the average qualifying worker would see a tax reduction between $1,400 and $1,800 annually, a tangible sum for many families living paycheck to paycheck. But as with every major policy shift, the devil lies in the details and in the backlash. The Nonpartisan Tax Policy Center released a study just days after the bill's signing that highlighted a key disparity. While about 60% of tip earners may benefit from the law, the remaining 40%, especially those earning less than $33,000 a year, would see little to no change, as many already owe minimal or zero federal income tax under current law. For them, the promise of no tax on tips rings more symbolic than substantial. Still, for middle-income workers in states with booming hospitality or entertainment sectors like Nevada, Florida, and parts of California, the impact could be felt immediately. In cities like Las Vegas and Miami, where tips often make up the majority of workers' income, many celebrated the news as a long-awaited win. Servers interviewed outside busy restaurants spoke of using the extra money to cover rising rent, pay down credit card debt, or simply afford a vacation for the first time in years. But as joy spread across dining floors and loading docks, a more cautious tone emanated from Capitol Hill, where economists and budget analysts began poring over the long-term consequences of the bill. The Joint Committee on Taxation projected that the tip income provision alone would cost the federal government $40 billion over the next 9 years, with the overtime provision expected to create an additional $124 billion shortfall by 2028. That is a staggering $164 billion in lost federal revenue. A gap critics warn could eventually lead to cuts in vital public services or drive up the national debt. Even some fiscal conservatives expressed concern, noting that while tax relief for workers is popular, it must be balanced with revenue integrity. Meanwhile, the Congressional Budget Office added fuel to the fire with its own estimate, predicting significant behavioral changes in the labor market. Employers, it noted, may shift pay structures to favor tip to overtime arrangements, thereby enabling more workers to qualify for the tax break. This shift could distort traditional wage structures, widen inequality between salaried and hourly roles, and lead to businesses over-relying on underpaid overtime to avoid hiring new staff. The Tax Foundation, a conservative-leaning economic think tank, published a stark warning: exempting large categories of income from taxation, while politically attractive, risks distorting labor incentives and reducing transparency in income reporting. It could also lead to widespread tax avoidance if loopholes are not tightly controlled. Additionally, concerns emerged around enforcement. The IRS already struggles to track unreported tip income, and critics argue that expanding tax-free zones could further encourage under-the-table dealings and inaccurate reporting, complicating audits and compliance. On the flip side, supporters of the bill argue that allowing workers to keep more of their money, particularly those in physically demanding or emotionally exhausting jobs, will increase disposable income, consumer spending, and economic mobility. The Donald administration emphasized this point repeatedly, releasing projections that showed the potential for billions in increased retail and housing activity in working-class communities. When workers are rewarded for working harder, everyone wins, Donald's Treasury Secretary said during a press conference, citing internal data suggesting an increase in small business formations in the service sector as a result of the bill. On the streets of Chicago, Atlanta, and Philadelphia, labor unions expressed cautious optimism, The United Food and Commercial Workers praised the overtime tax deduction, stating it could significantly boost morale and financial well-being for America's frontline retail and grocery workers. But they also urged Congress to consider extending similar relief to salaried employees, who often work beyond the 40-hour week without compensation. The policy's impact extends beyond the U.S. borders, too. Economists abroad are watching closely as the U.S. experiments with exempting categories of income in a system that's traditionally broad-based and progressive. European nations, which generally tax all income uniformly, have questioned whether such targeted exemptions could be replicated in their labor models or whether it would lead to instability and wage manipulation. On political talk shows, the narrative has taken on predictable partisan contours. Conservative hosts call it a tax liberation moment for working Americans, while liberal commentators denounce it as a misleading giveaway that does little for the poor and deepens economic inequality. Even among Republicans, there is a divide. Populist Donald loyalists view the bill as a signature moment of working-class advocacy, while old-guard fiscal hawks worry about exploding deficits and undermining tax code integrity. Despite all the noise, the impact on real people may prove to be the measure by which history judges this policy. Consider Sarah, a 29-year-old waitress in Nashville working 2 jobs to support her mother and young son. Under the old system, Sarah saw hundreds of dollars deducted from her check every month in federal income. Taxes money she never saw but always needed. Now, with the new law in place, she estimates an extra $1,600 a year back in her pocket. It's not going to make me rich, she says, but maybe now I won't have to choose between groceries and gas. Multiply her story by millions, and it is easy to see why this law could become a cornerstone of Donald's legacy among the working class. But the clock is ticking. This is a temporary measure, set to expire in 2028 unless extended or made permanent by future administrations. Already, some Democratic lawmakers are pushing for its repeal or replacement with more targeted credits aimed solely at low-income households. Others want to pair the provisions with new enforcement tools to ensure employers don't abuse the system or underreport income. Meanwhile, tax attorneys and payroll departments across the country are scrambling to update systems, retrain staff, and ensure compliance with the new framework, a bureaucratic whirlwind that reflects just how disruptive even well-intended reforms can be. As the dust settles, the country stands at an intersection between economic relief and fiscal responsibility, where ideology meets reality and where political ambition must face practical outcomes. Was Donald's move a genuine attempt to uplift America as hardest workers or a tactical strike to secure swing state voters and build momentum for 2028? The answer may depend on your place in the economy. For now, tipped workers and overtime employees have something they rarely receive from Washington: a reason to believe that working hard are one to be punished by the taxman. Whether this vision of tax justice will endure or collapse under the weight of fiscal pressure and partisan politics remains to be seen.